Rick, we're here, podcast number 3.
Yeah.
I know it's been trying for us. We've been very busy during tax season. And, just to let you all know in the audience, if you're trying to get a hold of your CPA, your EA, your tax accountant, your accounting firm, whoever's handling your tax situation right now, just be mindful of the notion that if they're worth a darn, if they're any good, it's going to be very difficult for them to, return your calls as timely in fashion as they had during non-busy season, just because, there's so many hours in a day.
Yeah. And I'd just like to remind people that, the filing deadline is coming up very quickly. And so if you have not gotten with your CPA, EA, your tax filer, at this point, it's going to be unlikely they're going to be able to get you filed on time. Most firms have a cutoff date when they need documents to them in order to meet that deadline. I know ours was right around March 21st. That doesn't mean that we couldn't get an emergency filing done,
Yep.
Right? But those are going to be one-off cases. Right now, I can tell you we've got a full backlog of clients that we're going to try and get filed in the next 2 weeks.
Yeah, and what I would also say to kind of double down on that, Rick, is if whoever you're going with, if they have time to advise you at this time of year, you might want to wonder why they have so much available time. Right? Not to say that they aren't a good accountant, but I'm in my experience, if they have a ton of time on their hands during this time of year, there's a reason why.
Yeah, I remember being a solo practitioner myself, just being by myself, no staff, no anything to help me. And this time of year, I wasn't taking meetings. If someone called me, it was, if it's a quick tax question, I can help you. But if it's something we need to sit down, it's going to have to wait until after the 15th.
Yeah, absolutely. I mean, I know with our firm, what we experience is we have certain windows that we like to do advising in, right? Yep. And then to even talk about that a little bit more, if your accounting firm is not advising with you, then it's just compliance work at the end of the day. And they're really doing you a disservice, because compliance is compliance at the end of the day. And yes, there are people who file tax returns incorrectly, but you should want more from your accountant than just someone to just do the tax return at the end of the year. Because once 12/31 of that year ends its course, there's really, our hands are tied. There's not much we can do.
Right.
I mean, you might be able to contribute to an IRA or something like that to lower your taxability, but it's really kind of damage control at that point.
Yeah. I mean, for us, really the only person I tell that I can't help as far as the tax planning goes is the person that's only working a job. They have a W-2 and they have no other source of income or anything else where we can do any kind of tax planning. But if you're just a retired person, we can help you plan your retirement, how much you should be pulling out, how to avoid some taxes, bumping up into that next tax bracket, maximizing Social Security benefits. There's all kinds of tax planning that can be done for just about anyone. But it's incumbent upon you as the tax person to reach out to your accountant and go, hey, I want some help.
Yeah.
And we're always willing to help.
Yeah, absolutely. Absolutely. For us, we always say, you're never just a number, right? Like, you matter. And that's illustrated on, we're very selective of who we bring in as a client, because we want people that are serious, and because we're serious about what we do. So anyway, with further ado, we're going to get into our podcast now. The first thing we're going to talk about, Rick, is 1031 like-kind exchanges. And there is a massive tax benefit associated with that. Would you like to kind of kick that off a little bit?
Yeah, no, I love the 1031 exchange rules. I utilize them with my clients as much as possible. This is really for your real estate professionals or your guys that just want to get into that rental property, maximizing that income without paying taxes deductions. And there's a lot of benefits to it, but there's a lot of misinformation out there about the 1031 and how it works. And I will say, we're going to go through some stuff, but I will say the biggest issue I see with this is people think I'll do the 1031 exchange and I'll do it by myself. And then I'll tell my preparer afterwards that I did this. And I have to tell them the bad news that you just foiled your own plans and now you're going to owe all these taxes because you didn't get with me or even another professional before you did it. So let's go through some of the big things here. The first one is identification, right? So you either have to have a property identified before you do the sale or within 45 days, you have to have at least identified this is the property I want. Now, what does that mean? That means you have to have gone and looked at it. You have to show that you've had a showing on it. Maybe you've got a temporary contract out there where you put a deposit down and you want to do a little bit more inspection before you close on it. But there's got to be something where you've said, I think this is the property I'm going to use to replace my old property.
Yeah, and in some instances, you can have more than one qualified property that you've identified. Okay, you don't actually have to make that decision on which one you're closing until 180 days.
Right.
But where it's going to hang you guys is if you have not actually showed good faith and have identified that property within 45 days.
Absolutely. And then the next big thing, of course, is when you sell your property, okay, you cannot take a single dollar out.
Or you're going to have boot.
Or you're going to have what's called boot. And that means that piece is taxable. And depending on how much it is, you could spoil your entire capital gain that you're trying to avoid paying on.
You've got to work through a qualified intermediary as well.
Yeah.
Okay. So this isn't just your tax advisor. Look, I'll be the first one to tell you, we can advise you on the taxes on this, but we're not qualified intermediaries.
No.
We will have to outsource that. And most tax advisors, they operate in the same fashion.
Yep.
So we got to make sure you have a qualified intermediary. Okay. Just to touch on a little bit more, the property must be like kind in nature, right? Meaning that if it's commercial property, it needs to be for commercial property. If it's residential, it needs to be for residential. And as Rick and I were discussing, if you receive any cash in conjunction with that sale, that's considered boot. That becomes a taxable event.
Yep.
Okay.
And it can't just be, hey, I put it in my savings account, so I never really touched it.
Yeah.
That's considered possession at that point.
Yeah, absolutely. Documentation is key, Rick. You have to document. And that's part of having an intermediary. They're going to help you with that process. And they're going to ensure that you stay within the confined lines of that 45-day window for identification, as well as execution of that new property within 180 days. So documentation's key, because if it gets called into question, you better be able to substantiate your position.
Yeah, and I want to go back and make sure when you find this qualified intermediary, this isn't your Uncle Bob or even an attorney sometimes. They have to be a qualified fiduciary.
That's correct. That's
okay.
correct.
They have to have those credentials that I am a qualified fiduciary. I'm able to hold someone's money for them on their behalf.
That's correct.
If you do not have that, game over.
Yeah, I agree. Great information.
Yeah.
So the next topic we're going to be talking about is why every American needs a trust in 2024.
You mean that's not for the rich?
Not just for the rich, okay? A lot of people think that, right?
Yeah.
Look, if you ever lose someone, it's very difficult, right? Your head's not in the game. You're all over the map. We all know. I know Rick knows firsthand. I know I do as well. The first thing that comes out for me, if you have a trust in place, is you're able to avoid probate. Mm-hmm. So it's one less thing that you have to deal with as far as the courts, as far as transferring assets out. You're not stringent to the same court laws that are associated with that. You can have a successor of the trustee already in place, basically where they can manage the assets. And this really comes into play, especially if that individual that passes, before they pass, they become incapacitated, right? They can't make key decisions. And also that trustee can basically manage the assets for the beneficiaries. So there's a lot of good things that are associated with setting a trust up. Some of them are tax related. Some of them are just legal elements that are associated, and just the ability, Rick, to make the process a little more, I guess, not as difficult to go through.
Yeah, I will say, I hear this quite a bit of someone comes in and they've had either a parent or a grandparent pass away, and they're asking us questions about, what legally can I do? What, and we're not attorneys. We don't ever advise on that side of the thing.
No.
But I can tell you, what 9 times out of 10, what happens is one of the kids or one of the grandkids gets a hold of the checking account, and they think, I'm doing this on their behalf. I'm going to spend this money. I'm going to go buy this $10,000 burial plot. I'm going to spend $20,000 on the funeral. I'm going to do this. And then everyone gets mad because that money's gone.
Yep.
And no one talked about it. And that's one of the things that, yes, a will is good. It can be good, but a trust is better.
Yep. Yep. Absolutely. Absolutely. Anyways, there are some tax benefits of a trust, and while we'll go over some of that today, I think it's key that we're going to continue to beat things in your head over and over again. That's why it's so important, right? That just because you might hear some good information from Rick or myself or somebody else out there, because there is good information out there, you still need to consult with a tax advisor, okay? You still need to make sure that you can, whatever information that you believe that you hear or that you read on something, that you can confirm that with someone who's an expert in that field. Okay?
Absolutely.
So Rick, you want to talk about if some of the tax benefits if it's an irrevocable trust, and how that could help out for a taxpayer?
Love to. So let's kind of get back to what's the difference between an irrevocable trust and a revocable trust, right? Yes. So an irrevocable trust means I'm going to put this in to this trust and I'm never taking it out.
Never taking it out.
Okay. Yep. A revocable trust is I'm putting it in, but still I can play with it myself. I can pull it back out. And where this comes from is cash or property that I'm putting in there. Mm-hmm. And maybe I put my house in there, my personal home, and then suddenly it's like, you know what? I want to pull that out and I want to put something else in. Well, that's what a grantor trust is, mm-hmm. versus an irrevocable trust, which basically if I put my house in there, it's part of that estate that's now been protected. It don't come back out. Mm-hmm. Okay. Mm-hmm. There are some great benefits to both of those, but the irrevocable trust is going to eliminate some of the estate problems that you could have from an estate tax standpoint. And that's why if you can, if you know that you've got certain assets, whether it's a brokerage account, maybe you've got stock that you've had for years and you want your grandkids to have that stock when you die, that's a great thing to put in an irrevocable trust.
That's right. That's right. But as Rick alluded to, if it's irrevocable, once you make that contribution, you no longer have that claim to pull it back out. Okay. So to gain or to maximize your tax savings for estate purposes and whatnot, irrevocable is the way to go. However, you're just not going to have the same flexibility.
Right.
And so you got to be careful, right? You got to understand whatever your intent is, and that's the route you need to go. But once again, I recommend sit down with a tax advisor, sit down with an estate attorney,
yes,
right?
Absolutely.
And kind of map this out together. And what I would advise you on is don't just do this, right, with just an attorney or just a tax advisor. You should have a team you're working with.
Yeah.
Okay. Because each team member actually are experts in their respective field, right? And where I see the hiccup and the issues on this is when accountants try to do legal stuff sometimes and legal people try to do tax stuff.
Yeah.
I mean, I can't tell you how many times, like, I know it's a little bit off topic, but they set up these LLCs, taxes, S corps, and they don't even have any idea how to file a 2553.
Right.
Right. And so they're under the assumption everything's set up for the client, and it's not. And then guess who comes in and cleans it up at the end of the day? We do.
Yeah.
So
yeah, and there can be some tax ramifications if things aren't set up properly. Now, an attorney can definitely set you up legally.
Yes.
Right. They're going to have the right documents, but do not let an attorney, especially if they're not a tax attorney,
yes,
recommend a trust to you and sell you on all the great tax benefits.
Right.
Because they may or may not be setting you up for failure. They don't know your situation.
Yeah, absolutely. And this is just another slide right here. The differences between a grantor and a non-grantor trust. The grantor, like Rick said, allows you to retain some control, where the non-grantor, you're basically relinquishing any control. Realize though, there's an increase in income tax for trusts as a whole, right? Trusts themselves have compressed tax brackets, meaning that they reach the highest tax rate at a much lower income level. So therefore, as we're talking about, to navigate through these channels, it's very important to seek out the right tax advisor to assist you in this, okay? Don't go willy-nilly out there and think you're just gonna be able to read some articles and you're gonna be able to figure this out on your own. Some of y'all might be able to, but it's even if you can or have the ability to, I still recommend meeting someone who's an expert in that field.
Yeah, I mean, I will say the tax brackets, most are 28% in the trust, right?
Yes.
Most individuals aren't paying an effective yield of 28%, right? So
That's right.
even if you're touching that 32 or 34% tax bracket with some of your money, overall, you're not paying 28 overall, right? So if you start putting a bunch of stuff into a trust and it's not properly structured to spit some of that money out so that you're not paying taxes on all that stuff, you could be paying a much higher tax bracket on income than if you just held it personally.
100%. 100%. Okay. So this is a topic that I did a little research on, Rick, and it might sound very outlandish, but how to create $1 million Roth IRA. Okay.
Perfect.
Look, the key element everyone's looking for today is how do I become a millionaire, right? And for the common person, sometimes that can just seem like a very uphill, treacherous battle. It's very difficult to achieve, okay? There's some specific elements, right, that we're going to hit on here and teach you how to get that $1 million Roth IRA out there. The first one is you want to max out your contributions every single year, okay? And for 2024, the limit is $6,500. If you're 50 or older, that number is going to be $7,500. You might go, well, Jake, Rick, that seems, $6,500 is good, but, ways off. Just relax. We're going to get you there, okay? Time is your ally on this, right? So the younger you start, that's how you're going to get there. But just because you're later in life, okay, it might be difficult if you start later in life, but that shouldn't hold you back from at least trying and making that attempt, right? You want to be key with your smart investments, right? You don't want to throw things that are high risk, right? You're going to want to make sure you minimize your fees that are associated. You're going to want to choose a brokerage firm, right, that doesn't have these outlandish stock transactions that's associated, or these maintenance fees that's associated. You're going to want to reinvest your earnings. And then, look, if you're older, let's say you have a traditional IRA or a rollover IRA, your 401k you've rolled over to your IRA. There might be a point where you look at converting that rollover to a Roth.
Right.
Okay. I remember back in, 2008, when the stock market pulled back pretty heavily, right? That was a key time to actually, when accounts were lower, were to actually make that conversion. So you knew it was going to go back on an uptick. That would have been the best time to actually do that right there.
Yeah. There's other things. Your employer may have a Roth version of the 401k that you can contribute to. And so that's another way to get really, because now I can contribute up to $20,000 to my Roth 401k rather than my traditional, right? We're big proponents of pushing on Roth because it's tax-free money, right?
Tax-free money.
So we pay our taxes now, and then when we get ready to pull it out in retirement, that's tax-free money, all the growth and everything else. And so one of our big issues when people get, that 55-ish, I'm looking at retirement, we start looking at how do we start shifting money over into the tax-free buckets, right? And this is one you talked about doing the rollover. It's under 72T under the IRS code. And what it allows you to do is start taking gradual payments without paying that 10% penalty and rolling it directly into a Roth IRA. Now, you do have to pay taxes.
You do?
You do. And that's where you need to work with a professional so we keep you from going up into a bunch of big tax brackets and paying more than you need to. But we can set up a schedule where by the time you're 65, even 70, if that's how long you want to wait, we've bled that traditional IRA out, and now it's all sitting in Roth, and it's growing tax-free.
That's right. That's right. So, getting back to it, you're going to want to increase your income. As your income increases, you're going to want to increase your contribution, I should say. You want to stay disciplined, Rick. Every year, guys, it's consistency over and over and over. Anyone that is successful in anything that they're doing, right, in business and sports, whatever it is, in investing, you have to stay consistent. You have to stay disciplined, right? And then you're going to want to seek professional guidance, right, with your tax advisor, with your financial advisor, whoever that is that you choose to be in your backcourt. You want to make sure that you're seeking the proper advice. So let's do the mathematics, okay? The mathematics behind making this Roth IRA, right, into $1 million Roth IRA is quite simple. So let's assume that you want to retire in 40 years, okay, at age 65. What does that mean? Well, that means that through this calculation, you need to kind of start at age 25. And for 40 years, you're going to have to make your contributions and your investments need to grow. Now, we're going to make some assumptions here, and we're going to assume that there's a 10% average annual return on the stock market. Historical S&P has basically gotten a 10% before inflation. So you'll need to make a contribution of $458 per month, okay, to reach $1 million by age 65. Now, this is going to assume that the contributions increase by 3% annually for inflation. So you're going to need to make those contributions annually, okay, that 3% uptick. After 40 years, realize that those contributions then turn into $1,000 due to the 3% increase, okay? But the compounded growth and the reinvestment for 40 years, your total contributions would have been $326,000. And the thing that's beautiful about this, the remaining $674,000 has been compounded investment income growth. Think about that for a second. Nearly 2x of what you had put in there had been gains from compounding and interest growth. So guys, start early. Stay disciplined, be consistent over and over and over. You can get there. Mm-hmm. Okay? You can absolutely get there. There's the mathematics behind it. We're going to put these PowerPoint slides out there for everyone to see as well. So feel free to go back and revert back to it. This is good information for everybody, okay? Rick, I know you hit on it just a little while ago, this slide. What we're talking about here is the benefits of a Roth IRA. You want to maybe just tap on it just a little bit as well?
Yeah. So, again, there's a lot of confusion. What's the difference between a regular and a Roth IRA, right? So the traditional IRA is that pre-tax money, right? I get that tax benefit right now because I'm putting that money aside. And we love that, right? The Roth, on the other hand, you're paying your taxes now. Mm-hmm. So that you can get the benefit on the backside of not paying taxes when you pull that money out on all the growth and everything else, right? And so what our recommendation tends to be for, especially people in their 20s, right? They haven't maxed out their income. They might be if they're a social media darling that making millions of dollars on, but that's not most people, right? So if you're in your 20s, you're probably at the lowest bracket you're ever going to be in. Why are you deferring taxes now? Defer your taxes later.
Yeah.
Let's get that money into a Roth so that when you're older and you are making money and you start pulling that money out, maybe now you're paying 10% on your taxes and you're avoiding a 20-25% tax bracket when you get ready to retire. So I've saved you 15% on that money by doing it that way. Another good thing on the Roth is, unlike a traditional, that money's locked up. You don't touch it till you're 59 and a half.
That's right.
The Roth actually allows you what's called a free basis draw after 5 years.
Explain that free basis draw to the audience out there.
So what that means is I spend 5 years with this Roth account and I'm maxing it out. I'm putting my $6,500 every year. Well, after 5 years, I can pull some of that money out, and it's called a basis draw. So you can't pull any of the earnings, but the basis I can pull out and I can use it. And I can do it tax-free.
And so that basis is your initial contributions that you had made.
That's correct.
Okay.
Yeah.
So any of the growth, like Rick alluded to, you're not able to pull that out, but any contributions that you had made over the years, you're able to.
So, maybe in 5 years, maybe you've got a great investment opportunity. There's that rental property you've been saving up for, pull 5 years worth of Roth contributions out. That's $30,000 if you're maxing it out.
Yeah.
That's a great down payment on a real estate property.
Absolutely it is. Absolutely it is. Great commentary, Rick. Thanks for adding some more to that. Okay. This is something that's been out there, guys, and something Rick and I are going to hit on. Everybody says, I want to know what the rich are doing. What are we missing here? Well, these are 10 capital gain strategies that the rich keep from you. And we're going to let you guys know what those are right now. Okay. And what I did, Rick, is I printed this off and I'm going to pass this back and forth, something for us to look at.
Sure.
Because as we go through these slides, it's a lot of information here. So just so you all know, we know this information, but it's good reference points for us to stay on track. So we make sure that we're giving you good information out there. So the first thing we're going to talk about is the Charitable Remainder Trust.
Yep.
Rick, you want to talk a little bit about the Charitable Remainder Trust, CRTs?
Yep.
A lot of people don't know what CRTs are.
Yep.
And there's an income tax deduction that's associated with that.
Oh, absolutely. So what a CRT is it's a way for you to give large sums of money away to different charities, churches, that sort of thing.
Yep.
and allow you to take a personal deduction for that charitable contribution, right?
Yes, yes.
And so there are some rules around setting this up, right?
Uh-huh.
And what kinds of assets you can put in there, right? But if you've got, say, a large cash or even a stock portfolio that maybe you've got a church that you want to donate that to over a period of time or even after you die, right? Absolutely, you can set these CRTs up. They can go in. There's a fair market calculation that's done on not cash, but other types of property. And then those property benefits, as they are distributed out to the charity, create a deduction for you on your personal tax return.
Yeah, and the thing that I like the best about it is, let's just say it's something, it's a charity that you're very passionate about, okay? And you have this appreciated asset, right? And you go, well, man, if I sell this appreciated asset, I'm going to have capital gains. What you can do is you can transfer that whole asset there. And then when that charity then sells that asset, there's no cap gains tax for that charity. Right. So that charity actually gets a greater benefit, right? And you go, wow, well, this was a charity that I had just a fantastic passion for. It's beautiful, right? It gives them more tax-free or after-tax dollars per se to utilize within the charity. It's beautiful. So there's a lot of different caveats here. We're not going to go over all the details of this. We have a lot of slides, a lot of things to go over. So we're going to try to stay on track. But charitable remainder trusts are definitely one of those investment vehicles that you probably need to seek out with your tax advisor that a lot of the rich are doing today.
Yeah.
And like I say, a lot of these CRTs are irrevocable trusts, meaning that you can't get the assets back out once you transfer in. You can receive an income tax deduction on a partial, but not necessarily the full. But like I say, we're not going to go into all the details on that now. I think it just, if you're interested, hey, there's going to be a link below. Make sure you click on our website, schedule a time with us. Rick and I would love to talk about CRTs in person with you. But this is an area that a lot of rich actually utilize. And if it's something of interest to you, as well as these other 9 topics we're going to talk about, please get in contact with us. We'd love to go over that information with you.
Sure.
Deferred sales trusts. Basically, you're deferring the sale of an asset, right, in exchange for a promissory note that you're going to receive back. And what that is going, that promissory note is it's going to pay you out like an installment. So it's going to pay you out over time, which allows you to kind of plan, right, as you have these installment sales. So let's just say you sell something for $100,000 to the trust. The trust is going to then give you a promissory note. They're going to pay you out over 5 years for that $100,000. Might be $20,000 a year. So now you can kind of plan and navigate with your tax advisor on to limit your tax exposure, and even from cash flow situation, various other elements. It gives you a lot of flexibility, Rick.
Yeah. Setting up a deferred sales trust allows you to avoid paying 20% on a lot of your stuff, especially if it's properly structured. You may pay 0 if you can keep your capital gains low enough. But most of the time we see this at the 15% tax bracket, which is still a great savings, right? 5% on the total sales, even if it's structured over a 5 or 10 year sale out period. It's better to pay small chunks than one big, large 20% chunk on a big sale.
Yeah, absolutely. Absolutely. But realize when you do these things, there are IRS regulations that must be adhered to. Sometimes it can be complex legal structures. So it's really important. And I know we've said it before, we're going to continue to harp on it. Sit down with your attorney, sit down with your tax advisor, map this out. If this is something that you are interested in, Rick and I can help you. We can put you in contact with attorneys that can help you. But this is just a second aspect, one of the slides we're going to talk about that a lot of the rich are doing right now to minimize their tax exposure.
Absolutely.
Okay? 1031, this is something we talked about earlier. We're not going to go over it in great detail here because we kind of went over it in a little more detail earlier. But as we talked about, it is a deferral on the capital gains if you meet the criteria. And just so you know also, if you ever receive cash, that cash is boot. Anything in excess of not rolling those assets over into a greater asset is going to trigger a taxable event for you. So once again, sit down with your tax advisor, sit down with your financial advisor, because also while we might be able to help you from a tax perspective or be able to chime in and what's beneficial, the financial advisor, if they're a good financial advisor, should tell you if that's a good investment, right? There's all these different angles you need to be looking at. So you really need a team you need to be working with.
Yeah. And I just last thing on the 1031 is if you're doing this just right, and let's say this is your only income strategy, right? Maybe you've only been a real estate professional. You've got a whole bunch of rental properties. 1031 can help you avoid paying taxes for a very long time if you do it right over a number of different years, right? Yep. You may end up getting to retirement and finally have to pay taxes once you liquidate everything.
Yeah, that's beautiful. That's beautiful. Yeah, absolutely. Like I say, things to remember. We talked about it. Like-kind property must be like-kind in nature. You have strict timeframes, 45 and 180. There can be a 60-day extension, but once again, you need to seek proper guidance. You need to have your tax advisor. You need to have your intermediary. You have companies that will help guide you with this. If you are looking for a company, Rick and I can point you in the right direction. Reach out to us, schedule a time. We're happy to sit down with you, whether it be a Zoom call, a conference call, in person, whatever that may be. We'll put you in the right direction, okay? We're gonna find you the right people, the right team to guide you through this process. The fourth strategy is opportunity zones, okay? Rick, I know you know what opportunity zones are and what they're designed for. They're designed for communities the U.S. government has looked at that they're trying to revitalize and encourage growth in those areas. And there's tax incentives that's associated with that. You want to hit on a few elements?
Yeah. So again, I'm going to harp on it again. Make sure you get with the right people on this, because there's all these things out there that say, we're a qualified opportunity zone. They may or may not be. Right. You really have to get with someone that actually knows what this is, whether it's a financial advisor, whether it's an attorney or an accountant, because what you don't want to do is stick money into something and think that you're going to qualify for this and it doesn't qualify.
Or you bust it along the way. Yeah.
Correct. Yeah.
Yeah.
And there are a lot of rules on it. It may be a qualified zone, but you don't do it right and you don't get the credit on it. Right.
Yeah. And I think the key is you have these advisors and you're consistently meeting with them.
Yeah.
Okay. I can't tell you how many times we've advised someone or met with someone. They schedule a 30-minute conversation, then they think they know everything that's associated. Well, sometimes tax law changes.
Yeah.
Right. Or maybe they misinterpreted. And then you never hear from them for 2 or 3 more years. And they find out when they sell the property, they busted the transaction along the way.
Yep.
And I want you guys to realize that this is a iterative process that you need to be meeting with your advisor. I like to meet with them at least twice a year.
Yeah. Yeah.
Sometimes quarterly, depends on their situation.
No, absolutely. So, to kind of get back into why these are good ideas. So you can put this money into, whether it might be an apartment complex that's being built. It could be a commercial property that's being built. Basically, they're trying to revitalize these communities by putting in new aesthetically pleasing job opportunities, whatever it is that they're trying to create in these zones. But there are some rules on how it has, how much of the funds have to go to different things. There may be a minority program that has to be in place. You have to hire so many people within the community.
Yep.
So there's a whole bunch of different things that you have to qualify for. Why are they great though? You're going to realize some capital gains in this, right? Because eventually something's going to sell and you're going to result in a capital gain. There's some deferrals and or exclusions from that capital gain that you can see that could lower your tax burden as opposed to having invested in a traditional investment property or something like that, right?
Yeah.
So there are some great benefits to this, but the rules around it are pretty persistent, and you got to make sure that the people that are doing it know what they're doing.
Yeah, I mean, one of the things that I like the most is if you hold your investment property for at least 10 years and it's qualified property, it meets all the standards along the way, potentially that appreciation can become completely tax-free. The capital gains is completely tax-free. But as Rick alluded to, we don't want to bust these transactions. So you got to consistently meet with your advisors and go over this. And so, like I always say, if you're going to do something, be all in. Don't be halfway in, 1 foot in, 1 foot out. That's where you're going to have hiccups. That's where you're going to make mistakes. Okay. We'll help you get through the process. Reach out to us. Happy to help. In areas that we aren't experts in, guess what? We will outsource you to those individuals who are. Just understand that that's who Rick and I are at the end of the day. We're going to put you guys in the best situation possible. So that's why we do these podcasts, is to give you guys as much information as possible out there, so y'all can make the proper decisions. But with those proper decisions, don't just take what we say and then run with it. Seek out additional advice and guidance along the way. Okay. So opportunity zones are great. There's, like, as Rick was alluding to, there's tax benefits for capital gains in a qualified area that is, and not just necessarily the opportunity zone itself, but for the asset that's being sold.
Yeah.
So a lot of information there. We're going to go ahead and skip into the next one. Something we kind of talked about with the DSTs. It's also just, even not with DSTs, is just installment sales as a whole.
Yeah.
Rick, and I know you know about that. You want to go ahead and hit on that?
So an installment sale is basically, think of it in terms of seller financing, right?
Yeah.
Basically, I have a house or a property or something like that. And rather than just taking a lump sum and paying the taxes on a huge gain, I defer that gain by spreading it out over payment periods, right?
Yep.
And so then all I'm recognizing every year is how much money did I collect in the installment sales, and allocating that pro rata across the deferred gain, right? And that can keep you from hitting that 20% tax bracket. Again, if you've only got so much income and all this coming in is just your total income, you may end up avoiding paying taxes if you keep your capital gains down, right? But at a minimum, we want to keep you at a 15% tax bracket rather than a 20% tax bracket.
Absolutely. And you can manage your cash flow a little bit better too due to installment sales,
Absolutely.
So things to consider. Not all gains will qualify for this.
Right.
Gets back to meeting with your advisor. Make sure that it does qualify. There are some reporting requirements. You have to file this now on 6252, which is an installment IRS form. We're very averse to that. We understand what a 6252 is. I've filed a lot of those over the years. Rick has as well. We'll help guide you through that process. Rick, I know that this is your category right now because you're kind of an expert on real estate professionals out there.
Yeah.
One of the areas that a lot of, wealthy people utilize is they become a real estate professional.
Yeah.
Okay. And they're able to transition part of their gains or losses from passive losses or passive gains to active income. You want to talk about kind of the real estate professionals, what is met, what some of the things that you benefit from that, and some of the things that you have to do? Absolutely.
Yeah. So I will start off with, you don't have to be a licensed realtor to be qualified as a professional. It really comes down to the number of hours, right? It's the service hours, 750 hours in a calendar year that is spent working. And that is, it could be going and viewing properties. It could be online looking for rental properties. It could be going to auctions. It can be any number of things. Now, you need to document this as if anything. Documentation's key here. You've got to document that you're spending this time on it, because what the IRS is expecting is, if you're calling yourself a real estate professional, that it looks like this is a job to you.
That's right. That's right.
This is not just some hobby. You don't have a real estate. You don't have a piece of property that you're renting out, and you maybe drive over there once a week to check on it, and you spend an hour or so a week doing it. No. This looks like a job. Okay, maybe a second job, but it looks like a job that you're taking seriously. You're doing the record keeping. Now, if you are a realtor and you're in real estate full time, you're likely going to qualify without much. But I'm really talking to the people that I'm just a real estate investor. I'm not really a realtor, but I want to qualify as that professional. What do I have to do? Well, you got to spend that 750 hours, and you need to document it. Okay.
Yeah.
The other thing you need to be aware of is, why do people want to do this? Because real estate is a great tax advantage because you can take depreciation and create some losses, right?
Right.
But it's a passive loss. And for most people, they don't get to take those losses because they don't have passive income to offset it against.
Right.
So I want to be this rep, right? Because I want to be able to take that loss and call it an active loss and offset it against my W-2 income or my business income or anything else that I've got. Again, document, because if you don't get to take that active loss. It remains a passive loss, and you don't lose it, but it's hard to use it.
Yeah.
Right.
Yeah, absolutely. Yeah. I mean, I don't have much more to contribute to that. I mean, seek the professional guidance to make sure you're qualified. But yeah, as Rick was alluding to, basically passive losses can only be offset by passive income as a whole. They have these phase out provisions based on your AGI and things like that. And we won't get into details on that, but the real benefit is like Rick said, right? If you have depreciation now and it has taken that, what would have been normally considered a passive loss, negative, now you don't have the ability to offset that on W-2 wages or any other active income unless you become a real estate professional.
Right.
So that's really where that is. Rick, I hate to do this to you. I'm going to let you're such a, this is your expertise. The short-term rental loophole that's associated.
Yeah. So this is, I tend to think of these as the Airbnb deductions, right?
Yep.
Okay. So, and there are a couple of short-term rental loopholes. Okay. You could be using the Augusta rule, which is a short-term loophole, and that is the 13-day rule, right? So if you just have and that has to be your main home. That's not a rental property. That is your main home that you're renting out for whatever. Maybe you go on vacation and you want to earn a little bit of money, and so you rent your house out while you're on vacation. You can use the Augusta rule for that. But this is typically for that person that's the Airbnber that's like, I've got this beach house and I want to do, weekend vacations for people to come in and do stuff. Well, most of the time, those are considered to be more like a hotel than they are a traditional real estate property. Well, that's actually, there's some benefits to that, because that means that if I have a loss, I'm not running a real estate rental property. I'm running a hotel that's an actual business, which I'm going to file on Schedule C rather than on Schedule E, which means if I have a loss, that's an active loss.
It's an active loss. That's
and
right.
I can take that straight off of my W-2 or any other business income I want. So that's one of the great things about it. Now,
and you don't have to be a real estate professional for that.
Right.
Yep.
And you don't have to be a real estate professional. The only problem with that is if you don't have a loss, you have net income. Now I'm subject to self-employment taxes, right? And so that's where we look at you and go, okay, well, maybe you need to be an S Corp then.
Yeah,
right.
Absolutely. Things to consider, like we talk about material participation. Are you materially participating? Shorter rental periods applies to rentals that would stay shorter than any specific time frame, often 7 or 14 days.
Yep.
If it's a long-term tenant in there, it's not going to qualify, guys. Okay. So like I say, record keeping, state and local regulations must be adhered to. And overall, like if you're operating as a short-term rental, it's going to qualify as active income or active losses. But like it say, sit down with a tax advisor like Rick or myself, and we'll help get you guys navigated through that.
Yep.
Okay. So anyways, strategy number 8, this was still, pretty much what we talked about. Everything's the same here. We're going to go ahead and bypass into intangible drilling costs. Rick, I'm going to talk about this, start talking about this right off the bat. This is what I see from a lot of financial advisors that they kind of roll out there, these PTPs or these MLPs, right? Trying to get people to invest in these oil and gas wells, right? Realize that these oil and gas wells cannot be offshore. They have to be onshore.
Yep.
That's the first thing. But what it can do is you can take a deduction for the startup costs that's associated, right? And what they typically do is when the K1 rolls to you, what I've always seen, Rick, is that first year that K1 rolls in there, they have you booked as a managing member oftentimes, and then the next year you go to passive. right? So you're able to, when you make that initial investment, you're able to take that deduction, that full deduction on the intangible drilling costs in that first year.
Yeah.
So I've even seen situations, oftentimes 70% of their IDC is able to be deducted on that investment right off the bat.
Yeah.
Years ago, I remember 10 plus years, maybe it was 15 years ago, time now. I remember it was up to 85% at one point in time when they first came out.
Yeah.
I think now it's closer to around 70% on the IDCs, but it's a significant amount of that person's investment. Now, what does that do? When you're able to deduct a loss on your taxes for your investment, that lowers your basis. Okay, so let's just assume that you make a $10,000 investment in there and you take a $7,000 loss. Now you have your basis has now been eroded from 10 down to 3. Okay. So you're an investor. So you can't erode that beyond zero. So just understand and be privy to that these intangible drilling costs, while they can give you a tax savings, that's great. That's very beneficial. But also, if I'm an investor, I'm looking at it on, is this well ever going to produce, right? Because I want an income stream that's coming. And a lot of times these investments, they go belly up. Yep. So you get the deduction and these wells never produce, or they produce at a very nominal rate that it's a terrible return on your investment. I'm not a big fan of them unless you find the good wells. Yep.
And I can tell you, a lot of people do this. They use these independent producers because they get 100% on the IDC, right?
Yeah.
So they use the independents. Well, you're more likely than not with those independents to hit a dry well.
Yeah.
Which means that you're not going to get any money out of it. You basically just sunk 10 grand into a company. Yeah, you got a $10,000 deduction, but you can get any return.
No.
That money would have been better off in your pocket.
Yeah.
Investing in, as you brought PTPs in and MLPs, much greater chance of a return on your investment, and not a bad situation. But like you said, you start off as a managing member so that you can take that active loss. And then you get into a limited partnership, which then limits how many of the deductions you can take going forward.
Yep.
So just be careful on that.
Yep, absolutely. And like I say, if you have questions on this, Rick and I have seen this for 15 plus years, done a number of returns over those time. Let us know. Happy to help you along the way. Solar credit. So they extended it. I know that it was supposed to expire, Rick, but it's up to 30% of the cost of the solar, which is beautiful. Guys, the government's trying to get everybody on board with solar. Okay. And, if you find a reputable company that's able to do that for you, I would definitely, consider it if you have the funds to do that. Look at what your long-term return on investment is going to be. A lot of them say 7-10 years, things like that. But part of that 7 to 10 years return on investment is due to the fact that you're getting this upfront tax credit. And now it's been extended all the way through 2032. Okay, that 30%. It will start to gradually decrease. Like for instance, in 2033, it's going to go down to 26%. If you have questions on it, sit down with Rick or myself. We're happy to help you. Very well versed on those elements and get you through the process for solar investment. But a lot of the wealthy, that's what they're using right now is solar investment credits.
Yeah, the warning I would put on this is a lot of these companies know these credits are out there, and a lot of them are scamming people. They're going door to door, knocking on the door. Hey, you can get 30% off on this. And a lot of times what you find out is they've jacked the price of the solar up
to offset
the 30. Then they're going, we'll even file your credit for you. Right. And all they've done is they've jacked the price up, and then they're applying the credit back to you, and you're still paying 100%. And net, you didn't actually realize anything off of it.
Yeah, it's very important. Very, very important. You deal with someone who's reputable, guys. Okay. Okay. This is something that, Rick, I'm going to hit on this for a second. There's a guy that I kind of follow out there on YouTube. He's a CPA and attorney. He's given some really bad advice out there. And I actually had to go do the calculations for myself to see where this is at. This is a subject matter that a lot of retirees have asked me over the years, and I'm sure they've asked you as well. Is it better to take an early draw on their Social Security, or should they wait till the full retirement age. Okay. So right now, the full retirement age is 67 to receive benefits. Right. That's going to change. There's a lot of information out there that eventually, as we start to live longer, they're going to continue to ratchet that up over time. But we're going to talk about it as of today, right? And so early retirement can be 62. Okay. So the maximum benefit, if you retire today at 67, is $3,822 a month. Okay. If you take early retirement, that's going to be $2,866.50. So basically how the math works is you get 75% of your full retirement if you start taking it 5 years early, okay? But some things I want to hit on here. So the average life expectancy at birth right now is 77 and a half years of age, okay? If you're a woman, it's 79.78, and if you're a man, it's 74.12, okay? Assuming that you're maxed out at age 62 and you were to receive a 5% return on your investment. So what this is assuming is you're not going to live off of those funds. You're going to reinvest those funds. A 5% compounded annually, okay? By age 87, I want y'all to realize this, by 87, if you start at 62, okay? That's a full 10 years past the average life expectancy, man or a woman. You would have accrued up to $1.758 million. But if you wait till full retirement age, you only have 1.638, Rick. So even 10 years past the average life expectancy, because you start that compounding element 5 years earlier, even though you're taking 25% less, you'll turn out with more of a nest egg.
Well, on top of that, there's a dollar per dollar reduction in Social Security benefits for other sources of income that you might have that no one ever takes into account. They always like to show the maximum. This is what you're going to get. And they don't show the fact that, I'm a teacher. I've got TRS retirement. My Social Security gets reduced for that. And that's a whole nother discussion of can teachers get Social Security and TRS? You can. There are ways to do it. But maybe you have a pension with a big company like Exxon, or maybe you've got something else, or just a 401k. You have to report just like on your tax return goes to the SSA and they look at what was your income last year. Well, we're going to reduce your benefits this year because you had so much income last year. And those are the kinds of strategies that need to be implemented when you're talking to your professionals about here's what my retirement portfolio is going to look like so we can maximize when is the appropriate time for you to take out Social Security. It may be age 62. It may be age 67, depending on what other things you've got. But also, as you alluded to, life expectancy. One of the things I sit down and ask people, I get kind of personal with them and I go, how long did your parents live? How long did your grandparents live?
What's your health right now?
Yeah. Did daddy die of a heart attack at 67? Well, why are you going to wait till 67 to take your retirement benefits?
Yeah.
Right? I'd go ahead and take that money right now. Life's not promised.
It's not. Tomorrow's not promised.
Right.
For any of us.
So one of the things that you need to work with your financial advisor, your accountant, your attorneys as you're developing these plans for retirement is understanding what is your life expectancy, right? And what is your dollars in retirement actually going to look like? Because once you die, Social Security's gone. That's not something you get to pass on to your heirs, right?
Nope, it's gone. It's gone, guys. Okay. These are 5 underutilized write-offs that are out there, Rick, that a lot of people just underutilize these things. And the first thing I tell people is if you have a business, this is for businesses, okay? You need to comb through all your bank statements, all your credit card statements, okay? Look, we're not telling you to fabricate expenses or anything like that. It has to have a business purpose behind it, okay? But you need to go there and look at any of your travel expenses, things that were associated with your business. I can't tell you how many times people forget, oh, wait, I did this in business. I did that in business. Go through and comb through what those expenses are. You know, meals, you might have had a deductible meal that you forgot to take account for, okay? You get a 50% deduction on that. Your home office supplies, your equipment, electronics, things like that. You know, your cell phone, your home phone, drones, tripods, things that you use in your business. auto mileage, picking up supplies, going out to a conference, meeting with a potential client. All those are deductible items. But it's key. Look, make an appointment with Rick or myself. We'll help guide you through that to see what qualifies and what doesn't. We don't want you to take an erroneous position, but we don't want you to leave money on the table either. Okay. So that's why it's really key. And we like to tell our clients to keep their books updated every single month, right? So you don't have to, retroactively go back and try to figure out what these are. It can be very difficult at times. However, if you are that procrastinator, and the reality is a lot of people are, okay, you need to go back and take the time to go comb through and see, what you might have spent some of your dollars on and what was the purpose? What were you trying to accomplish? Was this a business related item? And if it is, let's make sure we claim those things.
Well, and the other thing on this is because, you're talking about personal expenses that were spent in the business. If you're an S Corp, you can't take that deduction.
No.
It has to be run through the S Corp
Very true.
itself, right?
Very true.
So we need to know that ahead of time before we file that S Corp tax return of, oh, wait, I spent all this money and it needs to be run through the business.
Yep.
Now, if you have a partnership or sole proprietorship, absolutely,
they'll take us UPEs,
those, right?
Yeah,
but those are not available on the S Corp or a C Corp either, right? So we need to make sure we're accounting for those things before those business taxes are filed.
Yep, absolutely. 3 steps to asset protection, Rick. Asset protection is very important today. We live in a very litigious society. It's not just for the rich. It can be for the poor as well. The first thing you want to do, Rick, is you want to assess your risk.
Yeah.
Okay. You want to look at, what do your assets look like? What areas of the world do you play in, right?
Yeah.
Where someone might want to come back and sue you for whatever reason. You need to understand that there's not a silver bullet for one-step process. You're going to basically try to create these barriers, right, to make things a little more complex. The more barriers, the more complex it is, the more expensive it's going to be. Okay. And when to do the asset protection, right? You can't have a lawsuit or know about a lawsuit about to come and then put things in place, right? You got to kind of already have this in place and be a little proactive. So asset protection is really, really important, for a lot of people out there.
Yeah, I will say, we tend to utilize LLCs a lot, right? As our first line of defense when it comes to protecting people personally. But there's one thing most people don't think about. They think, I've got an LLC, so I am protected. Well, you're protected from the business if the business has an issue, but is your business protected from you?
Very true. Very true. Yeah. So once again, guys, sit down with a professional. Sit down with someone who can help you through this process. I think in today's society, you got to have asset protection, right?
Yep.
No matter who you are. Self-directed IRAs. I like self-directed IRAs. You like self-directed IRAs?
If they're used the right way.
Absolutely.
I see them get abused a lot because we put the wrong kinds of assets in them.
Right. And you can break up those transactions really quickly.
Yeah.
They are tax advantageous. They give you a little more flexibility. If you're one of those individuals that is just kind of sour on the stock market, right? And you think that you can invest in real estate or precious metals or dealing in private equity, commodities, things like that, and you can get a better return on your investment, you want to be actively participating in that, I encourage you to do that. You got to run through a third-party custodian to do those things. There's some, as Rick alluded to, there are some fees and management costs that's associated, as well as there are some busted transactions. I know the first one comes to my mind because what I see most of the time is real estate is what these are.
That was exactly what I was thinking.
Okay.
People put real estate property in there and they think I'm perfect. I'm going to get to take this money, put it into a property, and I'm going to get all this tax-free money on it. And I'll be honest, I am a huge opponent of putting real estate into SDIRAs. And the reason why is the benefit to having real estate is to be able to take depreciation. Yep. And you cannot take depreciation in an SDIRA, which means you've lost the biggest deduction out there, the biggest reason to have real estate.
Yep.
Right?
Yep.
And here's the other thing. When you sell that real estate inside that SDIRA, it's not a capital gain.
No, it's not. It's not.
So if you're a high net worth income producer, you want capital gains because they're taxed lower than what you're getting.
Yeah.
Okay. And so you've just avoided the benefit of having real estate property, because now you've just sold it and now it's ordinary income.
Yeah.
So when you take that money out, it's taxed at your ordinary income rate. It's not the capital gains rate.
It is. Very true, Rick. Very true. You can't have any, one of the things that I always see get busted up is you can't have any encumbrances.
Yeah.
Right. So
no loans.
You can't have any loans on this deal. You can have, let's just say you find a piece of real estate, and that real estate, let's just use a round number of $100,000, and you only have $20,000. Now you can pool your $20,000 with 5 other investors or whatever, 4 other investors, and y'all can all buy that. But the key element is you can't have any debt that's associated with that. It will bust the transaction.
Yeah.
Also, you can't sell it to yourself. You can't sell it to a family member, things like that.
You also can't use it yourself. I see that a lot.
I'm
going to buy my own house, and it's going to be owned by my IRA. I'm going to live in it.
Yep.
No,
busted that transaction.
No, because what these transactions are designed for is that you can have no benefit personally from them, right? It's the same thing with people that try to start companies with an SDIRA, and they think, I'm going to invest my IRA money into my company, and I'll just pull it all out myself. No, you cannot have you cannot personally benefit from the transaction at all.
You cannot. And so you got to be very careful. Once again, there are specific IRS regulations that are associated with this. As we always say, make sure you sit down with a trusted advisor to make sure you're in compliance, because if not, you are going to bust those transactions.
Yep.
And when you bust those transactions, you're going to have a lot of taxes and penalties that's going to be associated with that, guys.
Yeah.
So without going into all those details, some of the things we did talk about was borrowing money, selling assets to yourself or a disqualified person, and providing services to the SDRA as well. Look, there's a lot here. We've got so much to continue to cover. But if you want to sit down with Rick or myself and learn more about SDIRAs, there are a benefit for them. But let us help guide you through that. Okay.
Yep.
All right. So this is one of the areas. So these last couple of slides, Rick, these are things that are very popular right now and kind of trending in our society. Shohei Ohtani. Okay. Shohei Ohtani received a ton of money. We're not going to get into his gambling aspect.
See, that's what I thought we were going with this.
Yeah. Well, we're going to get into the gambling here in a little bit. Okay. But not with Shohei here. So when we were, but yeah, that is an element we need to probably hit on as well. But basically it's this 10-year deal, right? If anyone has been following Shohei Ohtani, probably arguably the best baseball player of this modern generation. Guy can pitch and hit. It's a 10-year deal. It's $700 million. Okay. And so but here it's a deferral, like we talked about, right? It's a deferral, similar in kind to other deferrals. So he's only going to receive $2 million a year for the next 10 years. Okay. The remaining $68 million, he's going to receive that between 2034 and 2043.
Yeah.
Okay. So what does this do, right? So this frees up a lot of cap space for the LA Dodgers, so they can build a competitive organization today to hopefully win a championship. Okay. But where is Shohei's benefit on this? Okay. Well, if you know anything about baseball players, okay, and any sports athletes, we have a few professional athletes that I know we've done taxes before on. Let's talk about how that is taxed, right? And so, Shohei, you have 162 baseball games in a season. Half of those games are at home. The other half is on the road.
Correct.
If you happen to be playing in a respective state that has a state income tax.
Like California. So half of those 162, 81 games are going to have state income tax. The other states that he happens to play in will as well. So you have what they call allocation and apportionment. You're going to allocate and apportion whatever income. So now instead of $20 million a year, right? He's going to be receiving this $2 million a year. Yeah.
Okay. So I'm sorry, $70 million. So he's going to be receiving $2 million a year. So he's only going to be subject to state income tax for California for half of that. And then whatever states he happens to for the other 1 million.
That's a great point. People always ask, well, why is training camp in Florida?
There's no state income tax.
There's no state income tax. So for the entire month of March, when they're doing spring training,
Yep.
They're earning money and no state income tax on that money.
Yep. And so if you want to, and so we're going to dive a little bit deeper into Shohei Ohtani on this, right? And yes, we talked about the state income tax, but there's even a little bit more here, okay? And what we're not discussing is when he begins to receive the lion's share of that income, his age is going to be 40 years of age. Okay. And so by doing this, what it allows them to do is spread out that taxability, right? Where he might be in a lower tax bracket is what you want to do. So you can really like plan, right? So you have 10 years to plan to get ready. Okay. We talked about the state tax advantageous stuff, but Shohei is going to be 40 years old when he starts to receive the deferred income. Most professional athletes retire by the age of 40.
Yeah.
And he's probably going to as well. So you can go find tax havens for these athletes to go live in, right? You could go into the Caribbean islands like Bermuda, Cayman Islands, British Virgin Islands, right? You can go to European countries like Switzerland, Monaco or Luxembourg, maybe Singapore, Hong Kong. Now, some of these places, though, you have residency requirements, right? But guys, he's got 10 years to plan for that, right? So, you know, your guy, Shohei Ohtani, you can go find these tax havens, kind of similar like we did in the first podcast, Rick. We talked about Jake Paul and Logan Paul going down to Puerto Rico, right? But now, you know, he's an international guy. He can find those tax havens that he can receive the lion's share. And now he didn't have to pay state income taxes on the lion's share, as well as potentially either a much lower federal income tax or no income tax at all.
Yeah.
So there's a lot of opportunity here. Dubai is one of the areas, part of the UAE. You know, they don't have an income tax. Now they do have other taxes that they charge on. But like I say, a lot of these places are going to have residency requirements. There's a lot of stipulations. Might work for him, might not work for him, but that's why he did it. Okay, that's why he did it. If you need some help on any of that information, give Rick or myself a call. We'll happy to sit down with you and help guide you through those processes.
Yeah, and unfortunately, guys, I will say the IRS is not dumb.
No.
They know exactly why this was set up, and I would guarantee you they're going to put a rule in place now that this, because you have all these big baseball, basketball, football players. They're all going to try and do this, and the IRS is going to go, well, wait a second. You're paying this money out, but they actually earned that money during that contract.
You know what this makes me
And you're
think
going
of?
to see some clawback of that money and go, we're going to make that apply to 10 years ago.
I won't be the bit surprised. You know what the first thing this made me think of when I saw this? Different subject matter, but along the same lines, transfer pricing.
Exactly.
That's the first thing I thought of as transfer pricing. Is basically when you transfer, you know, you'll have a company like Apple or something like that will have this tax haven, and then they'll transfer the majority of their income to that tax haven by just reallocating a percentage based on marketing or intellectual property or whatever in that respective country to trigger either a lower taxable gain per se or no taxes whatsoever.
Yep.
And so IRS is keen on this. And I think eventually this will be one of these deals that gets busted up, but it's a little loophole for now for them.
Sure.
You know? Okay. So this was a subject matter that was trending right now. I don't even really know who this Ruby Frank is. Apparently she was on trial for like murdering or injuring her kids or something, but she's this YouTube star. Okay. And so where we're playing into this is, so she roughly made $2.5 million from her 8 Passengers YouTube channel back in 2021.
Okay.
You know, basically, how are YouTubers taxed, Rick? And so they're going to be taxed through ad revenue, sponsorships, affiliate marketing, merchandise sales. Basically, she is actively working, right? So she's going to receive a 1099 a lot of times from YouTube or these affiliates, right? So she's going to be subject to self-employment tax.
Right.
She could have navigated, maybe she has, maybe she hasn't, right? Creating an LLC tax as an S corp, right?
Yeah.
Minimize her self-employment tax strategy.
Yep.
If she's doing affiliate marketing or merchandise sales in respective states, she could potentially have state income tax in those states.
Correct.
Right. So where we're just kind of hitting on is this is just what kind of was a trending topic. Like I said, I don't really know who Ruby Frank is. I don't know anything about it. I just know that she was trending right now, and she's I guess a popular YouTuber out there. And so we just really wanted to hit on how these YouTubers are taxed.
Yeah. I mean, the one that I know the most because my kids are into it is Mr. Beast.
Mr.
Right?
Beast, yes.
Right? And I think everybody knows who Mr. Beast is.
Yeah.
Okay. He's one of the most popular YouTubers of all time.
Yeah.
He's got a food product now that he sells. He's got a candy bar product that he sells. He's got all of his YouTube stuff that he's going on.
Yep.
I guarantee you he's got several tax professionals working for him to maximize his tax strategies.
Absolutely,
right?
he does.
So if you're looking to be a YouTuber and gain a following and make a living off of it, get yourself a good accountant.
Absolutely.
So that you don't pay a buttload in taxes, because you may think, I'm here in Texas, I'm never going to pay state income tax. Maybe not. Maybe not.
Yeah. So, it's real important to have the right advisors in your hand. If you're a content creator, no matter what your profession is, you really need to seek out the advice, okay? And don't go at this by yourself, guys, okay? And that's all we're alluding to with this. All right, man, big basketball game last night.
I know who Caitlin Clark is.
You know who Caitlin Clark is. Okay, so NIL deals, right? So NIL deals, she is expected to make in 2024 roughly $3.1 million. One of the things that I didn't put on the slide here, Rick, was I actually heard the other day there's a basketball league that Ice Cube has created here. Okay. And she has signed up. She's going to play 17 games. I heard it on 610 Sports Radio here in Houston. And she's going to make $5 million before she ever goes into the WNBA.
Wow.
Okay. I think it's kind of appalling that her first year rookie salary will only be $76,000. She's making more money in college with NIL deals and now with this other league. But nonetheless, these NIL deals, she has to pay taxes on that, even though she's in college.
Yeah.
Okay. So basically, if she's securing these deals with sponsors, she's gonna need to pay taxes. So NIL deal stands for name, image, and likeness. Yep. Okay. You want to talk about some of these and basically the self-employment tax, kind of similar to before?
Yeah, no. So where most people know about this is college football, right?
Yes.
This was the new rule that allowed colleges to pay athletes, whether you agree with that or not. That was the rule that was put into place so that they could recruit people by going, you come here, we'll put a deal in place where you can sell, you can do autographs, you can do this, you can take photos, you can go down to the local car dealership and do an ad for them. And we're going to, you're going to get this money. It's not going to run through the college. All these other places are going to pay you for it, but we're going to allow you to do it. Well, it's income, right? And these athletes now have to pay taxes. And this is why if you are an athlete and you're going to college and you think you're going to make money off this, you better make sure before you sign with someone that you have an accountant and an attorney, not just an agent, because the agent's not looking out for you for tax purposes. I mean, how many stories have we heard about the agent stealing the money or not telling them about their taxes, and then now the athlete's going to jail.
Yep.
Right.
Yep.
And then that doesn't matter whether you're a Hollywood star, whether you're an athlete. Agents aren't there to help you from a professional standpoint. They're there to get you a contract.
That's right.
You need an attorney. You need an accountant that's going to help you avoid some of the tax situations that you're going to create, right? But you've got taxable income coming in off of these deals. You have a requirement to file your taxes every year that you're there. And some of this stuff can be subject to self-employment. In fact, most of it is subject to self-employment. There's no capital gains here. You can say, well, my logo that I've created for my personal image is a trademark thing, and it's just I'm selling it, so I should get capital gains. No, it's a product.
It's a product.
You're selling a product. You're going to pay taxes on it.
Yep. And so, like I say, there's a multitude of ways that we can help streamline the process. And if you have the right tax advisors, they can do the same. Guys, get yourself a team.
Yeah.
And get yourself a team that is proactive, that's willing to sit down with you, spend the time. I mean, you're worth it. You matter. And the people who have your best interests should want to spend that time with you. And if they're not willing to do that, you need to go find a new team member.
Absolutely. Yeah.
That's where it is. Okay. So yeah, Caitlin Clark, real big, great win last night by Iowa over LSU. I don't really watch much of it, but man, she's a beast.
She's very dominant at what she does.
Yeah.
Whether you like her personality or not, you think she's over dramatic. She's an athlete, and I a lot of respect for her abilities. Personal opinion: stay in college, get your degree.
Yeah.
you're one injury away from being unemployed.
Yeah, and she's making more money right now in college too.
Absolutely. and that's, guys, that's WNBA's fault.
Yeah, that is.
That's you want those girls to make more money. WNBA needs to step up, and they are leeching off of the NBA, who contributes to the WNBA.
Yep.
Okay. WNBA, do those women a favor.
They should
start promoting your brand.
Absolutely.
Okay.
Agreed.
Just like any other sport, women's soccer is phenomenal.
Yes.
But they promote women's soccer.
Yep.
WNBA needs to do the same thing.
They do. Agreed. So now we're talking about the gambling aspect, okay? And it is March Madness, right? March Madness is going crazy. Did you know in 2023, right? Obviously, we're in 24 now, so we don't have the numbers, but in 23, there was an estimated $15.5 billion in legal gambling just on March Madness alone.
Yep. That's just the stuff that goes through Vegas.
Yeah, right.
That's not the office pool. That's not any of that stuff.
Yeah. So basically what we're going to talk about is anytime you place a wager, right, you're going to receive a W2G, okay? And that's going to show your winnings. It's associated, okay? Now, this is for people that are, and we talked about it in our last podcast, that are not considered professional gamblers, right? So professional gamblers is much different. This is a non-professional. This is just a weekend gambler or once in a while gambler. You're going to receive these W2Gs, okay? And so these W2Gs are income, okay? Yep. And this income can only be offset by losses that you can substantiate, okay? In other words, your losses can, even though they might exceed your winnings, they can never generate you a loss on your tax return to offset other sources of income. And that's what I want everybody to understand, okay?
What makes it worse is it goes through Sched A.
Yes, it does.
And it's subject to a 2% of AGI reduction, right?
So that's a horrible thing.
If you make $100,000 in winnings and you have $100,000 in losses,
you might not be
able to offset all your income, because if you have W-2 income of $200,000 and you had $100,000 of winnings,
maybe you don't even itemize. You don't even own a house or anything,
Right. So now you've got $600,000 or $300,000 in income, a $6,000 bubble that you have to take off before you can take that first dollar of deduction.
Yeah.
So if all you had was your losses of $100,000, you're only going to get to take 94.
Yeah. Right. So there are some limitations. There's some filing requirements. Yep. Get with the right people to make sure that you have the right guidance on that and that things are filed from a compliance perspective the right way.
Yeah.
Okay. Very, very important. The new movie about a week and a half ago, I know the wife and I, we watched it, Roadhouse, with Jake Gyllenhaal and Conor McGregor. Tried to pull some earnings out there on Jake Gyllenhaal. He's real popular right now. I like him. Couldn't find any information out there. It's not part of public record. However, there was some good information out there for McGregor and his winnings, okay? So he sold in 2021, Rick, he sold his whiskey brand, Proper No. 12, for roughly $150 million, okay? Huge. Mm-hmm. In 22, his earnings were around $43 million. That was largely due to fights and endorsements and stuff like that.
Yep.
So Proper No. 12, that's going to be a sell of a business, right? His shares. So that's going to be taxed as capital gains.
Absolutely.
Okay. His fight earnings, what happens is we have professional fighters that we've done taxes for as well. What happens is they're considered a 1099 contractor. Yep. What we had done to help advise them is to set up an LLC, taxes and S corp, pay themselves a deemed reasonable salary out of that. And then what happens is when the UFC or any of these fight promotions actually pay them, they actually pay the entity, right, instead of them. So they're able to minimize their self-employment tax exposure. Don't know where McGregor is at, but let's just assume in his situation, Rick, that he was in Ireland. Okay. In Ireland, the capital gains rate is 33%.
Wow.
So massive. I'm sure he has the right tax advisors that's saying, okay, we're not going to be in Ireland when you triggered this taxable gain on Proper No. 12. But if he was not, properly advised, he would be 33%. Think about that, of that $150 million.
It's $50 million.
That is a ton, right? Now, he could have had that easily reduced down to 15%.
Yeah.
Okay? So over half of that could have been cut in half by proper advice. And so, that's why I keep harping on it. You got to have the right advisors, the right team in your place, guys. So yeah, Conor McGregor is doing quite well for himself out there.
Yeah,
You know?
he's a great athlete.
So anyways, guys, I want to thank you all today for listening to Rick and myself. Hopefully some of this information was good information, things that you can take from this, apply to the real world in your life. Please do your own research, add to it. If you have questions, reach out to myself, Rick. We're just so thankful and blessed that you are listening to us today. And hopefully this was good information for you. Realize we're always here to help. And if you don't have the right team members, or you kind of feel like you're on an island by yourself, look, guys, find the right team members. We'd love to be that team member for you.
Absolutely. Yeah. It's all about the professionals. At the end of the day, having the right team in place will save you a headache and a bunch of money.
I'm Dr. Jake Latimer, and this is Rick Yancey. We're signing off. Have a blessed day. Thank you so much.
Thank you.